Hello, my name is Stephanie Pemberton and I'm a member of Ansa Merchant Bank's Asset Finance team. Today we're going to take a look at the loan approval process for registered companies. First, let's talk about being compliant. In order to have your loan approved, the following documents are required. You'll need to bring in your Certificate of Incorporation, Articles of Incorporation, audited financial statements, 3 months bank statements, your most recent annual return, one form of ID for each director, and the company bylaws. If the company was incorporated before 1995, you will need to provide a certificate and articles of continuance. A lot of people ask, why do I have to submit all of these documents to apply for a loan? The fact is, greater pressure is being applied to financial institutions worldwide to meet the standards required throughout the financial landscape. Trinidad and Tobago is part of the Caribbean Financial Actions Task Force, the FATF. The FATF is our regional arm that monitors and controls our efforts in combating money laundering and terrorism. The requirements of the FATF are ever increasing and are closely monitored by the Financial Intelligence Unit in Trinidad and Tobago that reviews and identifies gaps in the process. Failure to comply can have a severe reputational risk, both as a nation and as an individual organization, leading to, but not specific to, being blacklisted as a financial partner. Assessing a company's loan application takes into consideration the 5 C's of credit, which you've seen in our 5 C's of credit segment. As a recap, the 5 C's of credit are character, capital, collateral, capacity, and conditions. Today we're going to focus on how we assess a company's capacity to repay. We use a number of ratios to assess capacity, and here are a few of the important ones. Let's look at the debt service coverage ratio, which is one of the most important ratios in assessing a company's capacity to repay. We'll use an example of ABC Limited. ABC Limited has a net profit of $1.5 million. Their depreciation expense is $60,000 and tax expenses are $192,000. As you can see in the table, there are a list of other expenses that ABC Limited has as well, such as electricity, telephone, administrative expenses, salaries, and wages. A bank will look at the earnings before interest, tax, and depreciation. This is referred to as the EBITDA. In this case, ABC has an EBITDA of sales $1.5 million, plus depreciation of $60,000, plus taxes of $192,000, which equals $1,752,000. Let's hold on to that number for a bit. We then look at a company's short-term loan commitments. Say ABC Limited has only one loan that they pay $10,000 towards per month. We take $10,000 multiplied by 12 months to find out what their loan commitments are for the year. This gives us $120,000. This represents their short-term loan commitments. Let's say that the new loan attracts $3,000 in monthly installments per month. So we are looking at a new commitment of $3,000 multiplied by 12 months, which gives you $36,000 per year. If before the company owed $120,000 per year, and for the new loan they will owe $36,000 per year, then their total monthly commitments for the year will be equal to $120,000 plus $36,000, which is equal to $156,000 in monthly commitments per year. Now let's get back to that EBITDA, the earnings before interest, tax, and depreciation. The debt service coverage ratio will be the EBITDA divided by short-term loan commitments, which is $1,752,000 divided by $156,000. This gives approximately 11, which as a ratio is 11:1. In this case, the company is generating enough revenue to service their short-term debts, and they would be considered a good candidate for a loan. It's simple. If your earnings are greater than your short-term monthly commitments, then your company will be a good candidate for your loan. Any company with a debt service coverage ratio of less than 1:1 will not be a good candidate for a loan. Now let's take a look at how you manage your cash. A word to the wise, do not drain your company of all its cash. A bank will not help you if they see that you're withdrawing all the funds needed to expand the business each month. One ratio that we use to assess a company's liquidity and cash flow is the current ratio. The current ratio is derived by taking your current assets and dividing them by your current liabilities. Let's take a look at another example. If a company's current assets are 100,000 and current liabilities are 50,000, the current ratio will be derived by taking 100,000 divided by 50,000. This will give you 2. So the current ratio will be 2 to 1, and short-term assets are covering the short-term liabilities 2 times over. This ratio will be a good current ratio. Now, let's take a look at it the other way around, where current assets are 50,000 and current liabilities are 100,000. Using the same formula, we divide 50,000 by 100,000 and get a total of 0.5. The current ratio will be 0.5 to 1. This means that the company is not able to meet its short-term debt. This will not be a good current ratio. Now, let's talk about leverage. We always hear this word leverage bouncing around, but what does it really mean? In business, leverage refers to purchasing an asset using borrowed funds in hope that that asset will generate more revenue than the cost of borrowing. Almost always, this involves a risk that the cost of borrowing may be greater than the revenue generated from the asset, causing a reduction in profits. A highly levered company is one that's financing assets mainly through debt, and a lowly levered company is a company that's financing assets through shareholders' equity or through profits. Now we're going to take a look at the debt-to-equity ratio, which will tell you whether or not a company is highly or lowly levered. Say a company's long-term debt amounts to 300,000 and the equity in the business is 500,000. The debt-to-equity ratio is debt divided by equity, which will be 300,000 divided by 500,000, which is 0.60. This will give a debt-to-equity ratio of 0.60 to 1. This is a low debt-to-equity ratio and is indicative that the company is lowly levered and is not financing operations mainly by taking on debt, which is a positive indication that they can meet their loan commitments. A high debt-to-equity ratio will be a ratio greater than 1 to 1, which will raise a red flag. Thanks for tuning in to Answer Merchant Bank's Banking Tips. We hope that these tips will help you organize your business better. Because at Answer Merchant Bank, we are committed to supporting local businesses. For more information, you can contact us at 623-8672 or email us at answerbank@answermacal.com.